Okay, this is Boogie's Revenge. We're live. It's Friday morning. We got the market open in about 10 minutes, and I'm here in the Discord as well as on YouTube. This one, I believe, is going to be a public stream as well. So if anyone is on like the Facebook or anything like that, they're more than welcome to join. But since we have the split audience, if one side asks a question, I'm going to have to read it out loud so that the other side can be aware of it, so it doesn't seem like I'm just rambling incoherently to myself. I do enough of that. All right, so we're on the super small account. It's $500. This is the one that we're doing the monthly contributions on and demonstrating portfolio growth and doing active speculative trades on a smaller portion of that. So let me just pull up the spreadsheet here so we can all see what the plan is. So give me just a moment here. Pre-market routine's all done. I don't have anything to look at really. I'm just looking at just some general, just a small list of tickers. Might be a little weird in the market today. We had JPOW yesterday. We had some pretty good volatility in certain areas of the market, but nothing to really squeeze over. All right, so this is a plan for this account. I'm just going to run through it really quick because you guys that are here already kind of know it. You're on board with the strategy. So basically, every month I'm just going to add a $500 contribution to this account, and that is the foundation of compound growth, right? Because they say it takes money to make money. In order to get to the point where you have the money to make money, you kind of have to treat it like a savings account, especially if you're struggling while you're trying to figure stuff out. You don't need to do anything super crazy and deposit your entire life savings, but it is nice to have a plan for the money that you do put in, as well as to make consistent contributions so that it grows. Okay. And that's kind of where the power from this comes from. It's not going to be the short-term speculative trades because those are obviously riskier, and we don't want to rely on that until we figure it out and can manage risk and all that good stuff. So today we're going to focus on the speculative stuff, but just a quick recap here. So every $500 that comes into this portfolio, I'm going to take 70% of it and put it into dividends and longer-term passive income investments, as well as reinvestments. I've already got some chosen that I'm going to buy next month, so I don't have to worry about trying to figure it out in the spot. And then the remaining 150 here, the remaining 30%, which this will double after October 1st once the funds settle, because that's another $500 that's in the account. So when that hits, then every day, basically, we're going to take 33% or 1/3 of the speculative amount, and we can use that for trades. So if you're on a smaller account like this and you're trying to trade like SPY and Microsoft and Costco, it's a $500 stock, you're going to struggle. You're going to take the losses that inevitably happen, and they're going to be big. So you have to be very careful if you're trying to do that on a small account like this. So that's why we keep it to a small position on a small portion of the portfolio. And I'm also limiting myself to one risky trade or one risky loss per month. And the reason for that is so that we can get that tax advantage, which I went over in depth yesterday on the PBU live stream, as well as the Rags to Riches episode. So this is just a quick recap. So basically, we're going to be operating in this box today. This 33% of 30% of our contribution in total portfolio amount. So we're not using 90% of the portfolio for day trades. All right. And then beyond that, here's a little breakdown from the tax stuff, which again, if you missed it yesterday, I'm more than happy to go right back through this stuff, but we did go over it pretty in depth yesterday. We had a PBU live stream and it was really, really detailed. So, all right. And then this just kind of walks through the other element here, which is how I plan on building out a dividend portion once the account gets a little bit bigger. I don't want to do it necessarily while the account's super small, but this is going to revolve around a dividend calendar. So, basically, we're going to shift the speculative amount here. We're going to take a portion of this, and rather than just trying to do day trades and option trades and all that good stuff, we're going to get into more active dividends. And basically, that just leads through, adding a contribution or identifying a portion after you make a contribution, taking part of that speculative allocation and dedicating it to active dividend trading. Okay. And then when that happens, you're just going to, I'm going to buy shares of a good dividend stock that has a declaration date, if applicable. I'm going to buy those shares before the date of record, and I'm going to own them into market close on that date. And then when the company closes the day, they're going to make a stamp of me in their little book, and then that entitles me to a dividend payout, whether or not I have the shares beyond that. So dividend payout is nice. And then the ex-dividend date, is the first day that the stock trades without the dividend, so I can sell it at that point, and I don't really care. But the data record is right before that, so I need to have them at close of business day on the data record. So once I sell the shares, I'm either going to have a price action, profit or loss, right? Because the price isn't going to stay exactly the same from when I bought it. And that means that if I have a short-term capital gain, I will have a tax burden on it. But if I have a loss, I can claim that on my taxes as long as I don't re-enter it because of the wash sale rule. And I can get 100% of that loss back at the end of the year, which offsets the tax burden on these capital gains. So I don't have to worry about it. It's pretty cool. It's a nice little system. And it all just boils down to knowing what options you have available. So for the sake of not going into that rabbit hole again, because I do like to ramble, I'll just leave that as the recap. And then if you guys are more curious, you can ask more questions. But it looks like the majority of you guys have already been through the gauntlet of me rambling about that quite a bit. So today we're just going to do some short-term active day trades on relatively cheap stocks. So this account has, currently has $70 free settled funds because I went a little bit bigger into the dividends, which is okay. So that means that I have 1/3 of that to trade with today, right? So if we take $70 and multiply by 33%, I have $23.10 to trade with today, right? At a maximum. I don't have to use all 23. And sorry. And, some people might be like, oh, that's not enough to make money. And the case is, it is. You just have to do it consistently and you have to do it carefully. Because if you're only trading with $20 and you make 30 cents in profits, for example, on a small account, that's decent for day trades. But more importantly, you're not giving away $10, right? And that's how it builds up. It's, 30 cents a day, 60 cents a day, $1 a day. It adds up very quick over time. And that's the advantage, right? And all while that's happening, even though it's smaller dollar amounts and you're not giving them back, but you're still making those smaller profits, you're developing your skill set. So when it comes time to having a bigger account, you'll be focused on percentages. You'll be focused on trading the trade, not trying to trade the profit. And you'll be able to capitalize on those better opportunities a little bit more aggressively. But while you're in a small account or while you're trying to learn, that is not the time to try that. So if you're not consistent, I recommend having some sort of system in place for long-term financial planning first and prioritizing that, and then building on that with the speculative stuff. So, so I just wanted to kind of explain that a little bit. And I know a lot of you guys are here just for like the options alerts and just the stock day trade alerts and stuff like that. But, that's great. But if you're finding obstacles where you can't trade those successfully or you can't consistently follow them, and even if you are and you're not making a profit, reach out to us, because I still, there's still ways to make money even when, market conditions are choppy or something like that. So I don't want you guys to struggle or or anything like that. So all right, so right here I just have WSR, which is Whitestone. It's one of the stocks that I was looking at yesterday. They have their ex-dividend date coming up. I believe it's Monday, or maybe it's today. And let's look it up. So we're going to go to stockanalysis.com, and I'm gonna look at the market stuff here in a second. But this one is a REIT, so that's a real estate investment trust, and basically it's just a managed fund that revolves around real estate. So nothing that we have to really care too much about, just understand they operate slightly differently. So if we look at the dividends, their ex-dividend date is December 1st, 2023. So it's every month, I believe. Yeah, it's every month on these guys. So there's the record date, right? And then there's the pay date. So these are typically 10 days, 7 to 10 days apart. Some stocks are 4 days. It's different for every single stock. But you can see here their ex-dividend date is, October 2nd, November 1st, and December 1st. So if we look at the calendar here, the 1st and the 2nd. So the 2nd is Monday. So you would need to have it before then. So I'd have to buy it today if I wanted that 4-cent dividend. Now, that's not the kind of trade that I'm looking for. It's a very inefficient dividend holding, in my opinion. So I'm not going to be doing that one. But just that's the kind of thing that I like to look for. All right, so the market is open. And I have Fisker on the top here as well, because they are doing they're issuing convertible notes. So if anyone isn't familiar with those are basically just think of them like a bond where the investor buys them, and then after a time of maturity, they're converted, if they want to, into shares. So it's kind of like an option contract. So they're trying to raise, or they did raise, I'm sorry, $150 million in gross proceeds, which is awesome. They had a 0% interest, so they don't have to pay extra on top of when they pay that back. And it's just nice. So good news for this company. Now let's see how the market responds to it. So if we want to, we can kind of look at this stock today, and I'm going to consider trading this just from a share standpoint. We're going to keep it on a nice small small position, right? Because remember, I only have $20 to trade with, or $23, whatever it was. So I'm not going to go balls to the wall on every single stock that I see, and I'm not going to look at SPY and be like, oh, I need to trade a 0-day on $300 contracts, right? Because I'm on a $500 account. I can't do that successfully and consistently unless I just take those losses. But then if I take the small losses, I lose the tax advantage. So I don't want to do that. This is chess. You can play chess or you can play checkers. I prefer to play chess because that's more consistent and reliable. So for those who are interested in SPY, we have a level of support here. We have a level of support here. And then we have a level right there at 429.03. 429 should be the strongest support if we do fall into that. 430 is also a major level for SPY. So let's go ahead and mark that one out as well. I'll just make that big, fat, and orange. Make it huge. Sorry, guys. Just takes a minute. All right. So this is all right. So really quick, if we just look at SPY, right? The closing bracket is right here. Okay. And for the bracket traders amongst us, you guys know exactly what that is. We have a counter candle at open. After a gap up, we get a bearish candle, which means that we should, in most cases, we should come back and test this bracket. So this white box here. So I'm going to just extend that all the way out to lunchtime. Right. And remember, it's not a guarantee. It's just a way for us to look for opportunities. Okay. So I'll leave that down there on the bottom for right now, but just understand that the price wants to come down here. Whether it will or not is not up to us. We don't control that. We only control our risk exposure at all times. So I'll just leave that up, and then we'll start looking at some other companies. So let's look at big. Somebody got a hot mic. I like big lots. I don't really like it for day trades, but I do like it for swings. But it looks like it's getting some push today. Typically, anything that moves over 4% is worth looking at on equities. So this is pretty good. I'm going to go ahead and split this top chart here up into dual charts, though, because I want to also keep Fisker on the radar here, because that is a good one. Now, I'm looking for a pullback on these. I'm not just going to try to chase into these big candles. What I want to see is I want to see a big a push, right? At some sign of strength. Oh, sorry, guys. I'm dying over here. And then I want to see a little pullback, a little red guy, maybe with a wick, maybe without. And then I want to see a continuation beyond that. Okay, that in textbook terms, this is a 3-bar play, right? We've got a big bullish bar, small indecision bar, and then another green bar. But in terms of engulfing and everything that minimizes risk, what I have here is a setup using this drawing. Let me just go ahead and do that. I have a breakout over the open of this candle, and I have defined risk right here, and then I have defined profit potential at some ratio of that risk. So 2.5, for example, would be right here. So that's all I'd really look to trade for the bulk of that position. So given this setup, we have a nice tight defined risk in this. It's a theoretical one because I'm just drawing it. But more importantly, we're not trying to chase into these bigger bars because this is how people end up buying the top, right? You buy the top and then you end up holding it, and that's bad. So with an engulfing approach like this right here on SPY, for example, if you were bullish, this right here would be the entry. This would be the stop loss, 1 cent below that. Boop, boop, boop. And then, oops, oh yeah. Wait, let me look at the actual price because I think that does 10-cent increments. 430.93. Yeah, that's good. All right. And then you'd want some ratio of that. So if you're doing a 1 to 2 risk reward, for example, that would be your take profit at new high a day. So this would be the setup for a bullish trader in anticipation of continuation after this gap to the upside. Now, I am not bullish on this particular setup. It may or may not flash out, and that's okay. But this, in my opinion, isn't worth chasing because of this big counter candle and the fact that the bracket's all the way down here. So I'd feel much more comfortable looking for support around 430 because that's just a stronger support. But that also tells us when not to chase into things because, you know, we can identify this as a risk and not take this entry, even though it's showing us the things we like to see. It's not showing them. It's not showing all of them, right? So there's no point in trying to force stuff. So let me kick it up to the 3 minute here on Fisker, and we'll see if that's a good chart. It's a little bit rough. I mean, it depends on if we get volume. If we get volume, I think the Fisker chart would be good on the 3 minute. And it looks like we should be getting some volume. And I'm also going to look at big lots here. And we'll see if we can get some engulfing candles. Now, big lots I'm using the 5 minute. It's got less volume. It's got less intent. So let's see where it goes. And I'm also just going to keep the chats open. So if you guys have any questions, feel free to ask. I got to make sure I'm not muted on my different platforms. Always in the habit of doing that. So again, this SPY trade right here, as soon as that breaks that low of 430.93, so 430.94 minus 1 cent, that would be the stop out, no questions asked. But again, we're not pushing into this because it doesn't look like a nice confident setup. And it's important to be honest with yourself. So knowing that this doesn't look like a healthy setup, right? We understand that it may still go up. And if that's the case, we need to be very careful about letting confirmation bias into the mix. Because if we kick ourselves in the butt and we say, oh, I knew I should have taken that entry, blah, 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 Pookie doesn't know shit. That's confirmation bias, and that's how you get hurt in the future, because that would have been an exception to this setup, right? And we don't want that. We want consistency and we want confidence. So just for the purposes of highlighting things, every red candle that we get down, if we're bullish, we can look for an engulf to the upside if it has minimal risk. And that's the name of the game right here. So if I'm drawing let's say we're in the first half hour. So let's say a 30-cent box, right? Let's just say that that's my max risk that I'm ever going to accept, right? If I put the top of that box 1 cent above this candle's open and I'm looking for an engulf of this candle, the low of both of these candles has to be in that box. If it's outside the box, it's too much risk. So I can pass on that automatically. I don't even have to look at the candle. And that's a little bracket that I can then use to just follow the candles down into the support level and then look for an engulf off of that support level if that's my confirmation strategy. So it's important to have something like that in place. And if you don't, and you're just kind of picking random candles and you're trying to figure out when you stop out or constantly find yourself compromising, that's a good sign that you need to slow down and make it a little bit more objective. So for example, right here, this would be a bullish engulfing entry. Now, again, this is also high risk, so there's no reason to jump into this. I'm just showing you what the two candles are showing. So if I just isolate these two candles, well, to the best I can, you can see here that the low of this candle is 430.94. This candle is 430.97. So this low is the lower of the two, minus 1 cent would be the stop loss. So in this case, if we were to just move this bracket out of the way, okay, we'll do one of those. And what's the open on here? 431.18 it would be. So 431.18 and 430.93. And then it's just a matter of adjusting that that profit so that you can make sure that there's no resistance levels in the way, and that you get as close as possible to that ratio without some resistance level getting in the way. So remember over here, right, on this engulf when it was developing, we needed a new high a day to get to that 1 to 2 ratio, right? And that's why, A, that was a risk factor because we knew that we needed a new high to get that. And B, obviously, we have this counter candle and the price wants to come down to the bracket, which it's doing. So again, we're not taking any of these. I'm just showing you guys what the confirmations look like. And then over here, we have a smaller profit range. It's a 50-cent profit range, but that's okay because it's nice and easy to trade. It's much safer given that we're still in a really rough neighborhood. So hopefully that makes sense, but it's all about just identifying those risks and not so much trying to identify the profits. And that's where people end up hurting themselves. So if you're struggling and if you're trying to figure stuff out, that's worth considering, right? So you can see all of this stuff is just falling down right now. And that's okay. It's just part of the market. It's also Friday. There's resolution on the Fed stuff so far. And I think we have a couple events today. So I'm not going to try to rush into anything. I'm just watching and waiting and seeing kind of where the price goes. Now on Fisker, we have a retrace. Right, we're in retracement territory. So if I were to draw this here, we're kind of close to where I would look to pick up some shares. So we'll do this. So we're in an area, right? And then I can look at the 1 minute if I wanted to use the 1 minute to really fine tune that entry. So if we get a nice small red bar here, and then we get an engulf, that'll give me defined risk and a clean entry off of this overall setup here, which is continuation. So I can buy one share if I wanted to as an anticipatory entry as soon as it breaks out of the box here. But you can see we got a nice tiny red engulfing candle. So I'm actually going to buy two. I'm going to buy them at market price as soon as we get a, oh yeah, we do. Okay. So I'm going to go ahead and buy two. Now we still need to understand there is a little bit of risk here, right? Because we still had that big, strong red bar. But what we can do is we can identify our targets and our stop loss. So this opening candle is 649. So our entry would be 650. Our low here would be 646. So I don't want it to drop below that. So let's go ahead and draw that out. And then we need to identify our ratio. So 2.5 is good. As soon as this breaks below 6.5, I will just hold control here, and I have sell all at bid. So I'll just take the loss on that and move on if it drops below there. Right. But so far, we've got all the criteria. Yep. And was that 646? Yeah, I'm out. All right. So I'm out. No questions asked, right? There's no compromise here. I'll take the, what was that, 8 cents loss. And I'm okay with it. Now, right here, we have another opportunity if we like it. But it needs to engulf. So there's no setup yet. Let's just set up for one buy, and I'll see if I have any. See if I have sufficient funds for that. Now I do, because I'm only using a third of the account, so it's not going to prohibit me. It's more about me just mentally keeping track and making sure I don't go over that $23. Now I bought 2 shares at like $12.50, so that's $13. So I have $7 left, which means I can afford 1 share. Okay, but does that make sense so far? Right, we've identified the overall setup here. It's on the 1 minute chart, so we're really trying to fine tune that entry. We've got clearly higher highs, higher lows. We've got a nice defined trend line here that we can use. Now I don't want it to come back down to here, obviously, but this is a retracement of this impulse. So that's what I'm trading, and I'm just looking to identify a confirmation within that. So I'll go up to the 2 minute. Typically, anytime I stop out, I like to kick it up a time frame at least. When I'm looking at confirmations, and that way you kind of manually walk yourself out of chop territory. So it's pretty good. And one thing also that you can do, I guess you can't on Webull. Yeah, never mind. We'll deal with that later. Let me just set up this one market buy here. Now this has a 2 cent spread on the bid and ask. So that is also something to be aware of. So if you're trading something low float, for example, you really got to be mindful of that, so that if you get filled at market, you're not getting filled like 5 cents out or 10 cents out. So the high of this candle here, I'm sorry, the open of this candle here is 649. So I'm going to place a line here at 650 because this is my threshold for when the price breaks over the open of the previous candle. So that's how we identify an engulfing candle. And I'm comfortable enough with the size of this candle for a risk. So I think we're okay here. Now, Big Lots also has a nice tiny body here, but I don't like this wick, right? The wick is very scary to me because, yes, it shows rejection to the upside, but it also shows weakness to the downside in order for that to have happened. So the risk in this case would have been, oops, it would have had to have been, gonna get these drawings out of here. So that would be the open up here, and the low would be right here. So that's a much bigger risk, right? And I don't care about the, oops, sorry, let me just look at this real quick. There we go. So I'm going to go ahead and buy 1 share of Fisker, and then I'm immediately going to set up a bracket. So Fisker, close position, take loss, blah, blah, blah. All right, so the stop loss here, I'm just going to put in place, and then I'm just going to move them in when we're ready. Okay, but I'm going to use the drawing tool to kind of establish that. So 650 is the entry. Stop loss here is the lower of these two, 644, so 643. Okay, 643. And then adjusting that ratio on the profit to get me to that 2 to 1, or the 1 to 2, I'm sorry. All right, so this is going to be 665. So let me go ahead and edit that order. Oops. Orders. Modify. What did I say it was? 665? I'm so bad at this. And then that is going to be 644, or 643, I'm sorry. Okay. So let's do that. So automatically, I have a profit potential here of 15 cents on one share, right? I've taken 2 shares, 4 cents each as a loss, which gives me 8 cents negative, but I'm making 15 cents on this one share. Now, if I use consistent profit size, position sizes, I'd have a 4-cent loss and a 15-cent profit, which is almost 4 times the amount that I had. And I can always move this stop loss up as well. That's never a bad idea, especially on an impulse like this. But you guys can see we had the overall setup, right? We had that big uptrend here, news, we got a positive catalyst, all that good stuff. We got an impulse, we got the retrace. It was nice and clean, that 50 to 61.8% range, right in the zone that we like. We got a tiny little engulfing candle. It's got confluence off this moving average, and we got good volume. And it's just a clean setup. Does anyone have any questions about that? Because I tried to make that as clean as possible. And I also know that my loss for the day, the realized loss, was 8 cents, roughly. Let me check. It might have got filled. Yeah, so 11 cents. Okay. So anywhere around 11 cents or above on this one, I could lock in profits intentionally at any time and guarantee myself net profitability. Now, if I was trading with a larger amount, or if I was trading a cheaper stock, for example, and I had multiple shares, I could scale out and I could sell 75% of the position up here and then let the remainder ride up or down. And the way that works is if I lock in profits on, let's say I lock in 10% profit on a swing. Let's just assume there's a swing. If I lock in 10% profit on that 75% of my position, that leaves the remaining 25% to go not only down to the entry again, but 3 times that distance down, which it won't do because I have the stop loss in place. So I'm guaranteed net profitability in those scenarios. So it looks like Big Lots is still pushing. And again, I liked this, but this wick here was just too risky for me. So we can always pass on it, and it's okay. Remember, this is confirmation bias, right? We don't want to be lulled in by an opportunity just because it happened to have worked out, even though it had bigger risk and unhealthy risk, because that's how we get hurt. So there are plenty of opportunities like this in the market. We just need to pick, we just pick the best ones. That's all. The best ones that we can be the most confident in. You're going to see a lot, but you don't have to trade them all. Okay. I literally just grabbed these stocks at random. Fisker was in the stock chat. Member asked about the catalyst, and then Big was just on my list here, and I noticed it was over 4%. So I grabbed it because I remember it was a cheap stock because I'm familiar with it. That's it. There's the magic. All right. So with SPY, remember, we're identifying engulfings here, and the bullish ones aren't what we look for, right? Because it's not working out. Okay. We know that we had a big gap at open. We got the counter candle. We know we have a strong support at 430, and that a lot of the bulls are just going to back out. They're not going to be jumping into this aggressively until it's in this range somewhere. Okay. So we've identified one. I'm sorry. This was the first engulfing opportunity, which again, we're not taking. This was the second. This would have been the third. And then this one here is bigger. So we probably would have passed on that one. This is more than 30 cents. So there's no reason to even look at that. Okay. So now we're going to flip the script a little bit and say, okay, where could we and should we have entered if we were bearish, knowing that the setup was that it was likely to come back down to this bracket? So for bearish engulfings, you're going to look for when the price action breaks. Oh, look at that. Fisker sold. So yeah, profit, right? And you're going to see some variance in this account here because I have bigger positions than that one share. So overall, our realized P&L seems to have broken even for the day, or at least Webull didn't update it yet. Let me refresh that. Realized P&L was negative 2 cents. That's probably just because of how we got filled. So I'm not too worried about that. It's good for demonstration purposes. Yeah, normally I don't trade things very tight like that. So if we were bearish, right, and on SPY, we're going to look at the white candles as the engulfing victims, and we're going to look at the red candles. Sorry, white is bullish on my theme here. And we're going to look at the red candles that engulf them to the downside. Okay, so we're going to look for the same thing. We're going to look for a big red candle here. Then we're going to look for a small white candle, and then we're going to look for a red candle that engulfs it, because this right here is our stop loss. This right here is our entry, and then our profit is down here at that, at least 1 to 1.5 or 1 to 2 or something like that. All right, so if we just go through each candle here, we can see that this may have been an opportunity. And I got my 30-cent bracket here so we can measure it. It's the same rule, right? So this would have been an opportunity right here. Let's see, would that have stopped out? Nope, it wouldn't have. So this was 431.39. So 431.40 would have been the stop loss, and none of these candles broke over that. So this first opportunity right here would have still been in the trade. Now, of course, if you're trading a 0-day, that theta and IV fall off would have killed you. But yeah, 2 nice little pushes so far. So let's look at the next one. All right, so then we got this opportunity here. All right, so this one would have fit as well. And the higher of these 2 candles is 431.36, so 431.37 would have been the stop loss. None of these candles have breached that, so you would have still been in that trade. The next white candle is right here, so let's look at that one. See where that gets consumed. That would have worked as well. It's a nice clean entry. So you can see that so far we've got better quality bearish entries than bullish ones, because we're not down here at the 430 level just yet. So so now we can follow these white candles, the bullish candles, down. And these are the pullback candles, right? And then when the red candles consume them to the downside in the direction of the strength, we can look for entry opportunities that have minimal risk. So in this case here, this white candle, this bullish candle here, didn't have a red candle after it that engulfed it. It didn't break the low. So that's kind of the first sign of bearish weakness, is that they didn't continue pushing in that direction. And that's okay. It just means that the strength is kind of cooling off a little bit. Doesn't mean that they're not going to keep pushing it down. It also doesn't mean that it's going to rally to the upside. So there's just an uncertainty time. So ultimately, by having these rules in place, this criteria, we're just telling ourselves when not to trade, right? And in this case, if we're bearish, we didn't have an engulfing candle, so that's a trade we can't take. We wouldn't have taken this candle. We wouldn't have taken this candle. We just continue waiting. Oh yeah, look at these wicks on Fisker here. You got 1, 2, 3 big wicks, sorry, and then a nasty engulf. So we'll see if that falls down or if it's just a retrace. So just for the sake of watching this, let's just draw those. This right here is the area people are going to watch for that continuation. So just kind of keep that in mind. And if we're bullish, remember, we can do the same thing. We just look for those tiny engulfs, minimal risk, right? In these areas of value or off these areas of value, and just trading those over and over and over and over. So it can be a little boring after a while. All right, so on SPY, if we kick it up, right, this is all we're seeing. We're seeing an impulse that ended right here. So this is now a retracement to the upside. So let's go ahead and draw the fib. Okay, let's identify that zone, the 50 to 61.8. That's a little tough here because it's so condensed. So let me stretch that out a little bit. All right. So this right here, if I'm a bear, okay, this is where I'm going to start to look for those little red engulfs, right, off these little tiny white candles. Oh, I got to turn this moving average off. It's stretching the price out. Sorry. There we go. That's much better. Right? Does this look clean? It's a nice bearish impulse. We know that the direction of the setup should be to the downside. We know it should be coming down to this box. Whether or not it's going to, I don't care. I don't have to predict anything. I'm just seeing what I see and looking to trade what is, not what if. Okay? So now I know that we have an impulse here and we're in retrace. We've hit the 50 to 61.8 zone. But I know that what I'm looking for is going to be a little white candle and then a big red engulfing candle, or something that exceeds the open of the bullish candle before it. okay, with minimal risk. And this area right here is the risk. That's what I'm concerned with. I'm not concerned with, how far down it goes or how far up it goes. If it goes beyond the range that I'm willing to accept for risk, I'm not going to enter it. I'm not going to look at it. I don't care. And I'm not going to try to predict where I think it's going to land. I can identify zones where it may land, and then I can trade it into those zones if it goes there, but I can't force it to go down there and hold everything, despite what I'm seeing. So let's just trade what is, not trade what if. All right, so for Fisker, we are touching the top of the box right here, but we don't really have a good clean engulf. I mean, this is smaller than the one that we had. So this is another opportunity where we can set up a trade and just wait to see if it happens. Now, I'm done trading on the speculative amounts for this account today, but it doesn't mean I can't still practice and get value out of it. Now, I could just keep trading and I could, do all kinds of option trades and stuff, but for the sake of education and, being consistent on this account, I'm just going to keep it nice and steady. Okay, so the looks like the risk here is opening up. So the entry would be above this candle's body, and the stop loss would be below the lower of these two. And at this point, that's looking like that. So that's pretty big. Therefore, we can pass. Okay, there's no reason to give those profits back. All right, so on SPY, on the 3-minute here, we're seeing the small white candle that we like. Right? As long as it stays small and then gets a red engulf that breaks below the open of this body, we're going to be okay. Now, if this continues to push, there's simply no bearish entry, and that's okay. At that point, we'd have 4 and then potentially 5 bullish candles, which would be a technical bullish impulse, and we can trade that. So we're just transitioning from setup to setup and identifying the confirmation that makes sense and has the least risk. So that's kind of the nugget of trading education. So, all right, so far, let's go ahead and look at this, and I'll set up a bearish opportunity here. Nope, see, that's getting bigger. So it's not terrible. It's only 18 cents so far, but we are beyond the 61.8% level. So that's a risk factor that we can identify right off the bat, and therefore we don't have to trade it. This may push new high, at which point we don't want to be in a bearish position. It may also just come close and then fall off around the 11.2% range, at which point we don't want to jump into that. So the key component here is that I'm not trying to impose my will on the market. I'm letting the market do its thing, and I'm just kind of along for the ride. So if you're frustrated and constantly hitting your head against a wall, take a step back and try to figure out who's actually in charge. Is it you or is it the market? So, you got to get yourself out of the mix a little bit. And, as Ethan was talking about yesterday on his stream, he's letting the chart tell him what to do. That's all we're doing. We're just reading a story, and then doing actions based on what we're seeing. All right, so if we're looking at big, for example, this is a much healthier opportunity than this. So again, if I'm drawing a box from the open of the previous candle to the low of the 2 candles that are participating in an engulf, that's what that one looks like. This is what this one looks like right here. So much smaller risk. This is a much cleaner opportunity. So I'm going to go ahead and map it out. I just need to make sure, yeah, it did break over. So let's go ahead and map it out. Okay, the open of this candle is 517, so I'm going to put this at 518. And then the lower of these 2 candles is 515 or 514, so 514 minus 1 cent. Oops, I erased that, didn't I? I'm so bad at this. Okay, so 518 was the open. And then the low is 513, or 514 minus 1 cent. Okay, and then we just need to adjust the profit. Oops, I have to move this here. So it's a 1 to 3. So let's drop that down to 1 to 2. And I do that by adjusting the profit. Now there's a 5 cent change here. So we're going to do 528 for 10 cents profit. And that's a 1 to 2 ratio. So this is the setup here for big. I don't encourage anyone to trade it, but just watch it, study it, see if it makes sense. Okay. Same thing here with Fisker. We're coming up on a better opportunity here. If this candle right here can break over this candle's open, we'll have nice defined risk. So let me draw that one out as well. Okay, so the open of this candle here is 656. So we're going to set that open to 657. All right, and then the lower of these two candles is 654 minus 1 cent, 653. And then we adjust the profit to accommodate the ratio. Oops, that's too far. 665. That should be or I'm sorry, 664. My bad. No, 665. Okay. All right. So that would be the setup. In this case, we didn't get a good entry on that. So did that actually break over or did it not? Yeah, no, it didn't. So 656, 657 would have been needed. It just didn't push over that. Now, since this is pushed lower and the candle's still forming, that increases the risk, right? Because this is now the lower of these two candles. So we know that this is, it's getting a little bigger. So maybe we don't take this one. Maybe we watch the next candle. So I'm just going to go ahead and erase that for now. Well, I'll leave it on there just so we can see how big that risk actually gets, because it's still acceptable in my opinion. But again, we're below that 61.8 level as well on this one, and we see how that's working out on SPY. So for SPY, it looks like we're probably going to try to push new high. And all we did is just not trade it, right? We didn't jump into a bullish position. We didn't jump into a bearish position. We're just looking for those really sweet setups. Okay, so for this one, I'm going to increase that, and I'm going to decrease that, and then I'm going to change that ratio. And you can just draw this position tool and just follow it all the way down. Now, this is below the 61.8, and we're seeing a lot of aggression here, which is because it failed the 61.8. It's technically bearish at that point. So at this point, there's just no trade for the bulls, right? We got to wait, at least based on this impulse retrace, right? So that means we have to default to the higher setup. So in this case, we had a double top. The impulse here is going to be to the downside if we fail this level right here. So let's just wait and see what happens. Right? There's no need to try to jump into these things. It should still be overall bullish, but there is potential for that double top to come to fruition and push down really hard. So I think that's what the bears are shooting for there. That's probably why we saw all that aggression once it failed that 61.8. And there's just nothing we can do to force things in a healthy way. So in this case, the big, that would have hit that stop loss, that 5 cent stop loss. And that's okay, right? Because we took a minimal risk, 5 cent risk. I'm okay with that. Now, again, I'm not trading anything else on this account for the day because I'm following a very specific plan, right? So exceeding using 1/3 of the speculative amount that I have left from the overall contribution does not fit that trading plan. It's not healthy. It's overcommitment. And I don't want to do that if, the market is indecisive. So I'm just going to keep following my plan. Overall, I've realized a 2 cent loss, and I think that's just because of the way I got filled. That is much better than a $20 loss. So we'll just wait and see what we get. And this account is a longer term plan. So, we're going to have situations like this where we kind of make back our losses. We're going to have positions where we're maybe a little bit red for the day. And we're going to have situations where we're hugely green for the day, right? We're just waiting for the ones that stick and keeping ourselves afloat when they don't. So that's kind of the name of the game here. Now, also, really important thing. I took a 8 cent loss, or maybe it was a little more. I think it was 8 cents. It was 11 cents or something like that. On the first Fisker trade with those 2 shares, that was negated as soon as I re-entered the position. So I couldn't use that 8 cent loss or 11 cents, whatever it was, on my taxes as a capital loss. So I gave that back. I lost on it completely. I lost the 11 cents or 8 cents or whatever it was. I also lost the tax advantage because I re-entered immediately, and that's a wash sale. So now I have to pay taxes on the profit, which is 15 cents or whatever. But I don't get the offset from the loss that I claimed previously. So hopefully that makes sense, but it's important to keep track of that stuff too. Now, obviously it's only a few cents and I really don't care, but when you're dealing with bigger dollar amounts, that stuff absolutely will matter and you're going to want to keep track. So right here, we've got a nice little bearish impulse on the Fisker 2 minute. So this will be pretty important. Now, this candle here, remember, if we're looking for engulfs, the entry would be above the open of this candle and the stop loss would be below the lower of these two. So we're kind of in that territory again where we're just we're looking for clean opportunities, and this is not it. I don't really like this wick. Now it may still, it could bounce, whatever. It could be a double bottom. but I don't like the confidence in it. So why would I trade that? You can also see here that if I increase this up to these highs, that's a 1.5, which automatically helps me manage my risk because it is a riskier trade. So I would want to have a smaller risk range. But I don't know, it's 8 cents. Don't know if I like that for a 1 to 1.5, you know? So we'll just wait and see. And again, I'm not trading this. I'm just walking you guys through it so that you can see it. So right here on SPY as well, this technical bullish impulse has ended. So now we're in a retrace. So if I erase all those, we've got a little fib, and we can identify the area. Remember, this has overall bearish sentiment because we want to come down and test that bracket based on this counter candle. But that doesn't mean we won't have short-term bullish pullbacks. Okay, so if I'm a bull, I'm going to be looking for a small red candle here, followed by an engulfing candle. Okay, we came right back to that retrace box. So we'll see what that gives us. If it gives us nothing, that's okay. This one is just kind of a placeholder as well. There's no trade here. The risk is just way too obnoxious for me. For this kind of setup anyway. Given that as soon as this fails, we've got potential for another one of these candles in the mix, right? Because this is a double top entry line. So as soon as this fails, you could just as easily get a flush out all the way down to 630s. I don't want that. Okay, so SPY broke below the 61.8. Let's see if it holds there. And remember, that's just a sign of that strength. The bulls did the same thing. They broke above the 61.8. Now we're breaking back down below the 61.8, which tells me I'm on the wrong time frame. So if I zoom back out and I erase that and I erase that, I can see how potentially bearish this is about to be. If this turns into a 3-line strike and we fail this level here and it doesn't bounce in the next 2 minutes, that's going to be a potential bloodbath for this gap. Now, that doesn't mean go chase into puts and all that good stuff. It just means that we need to be aware of what's going on so that we can make informed decisions. So right here, this 652, 653 would need to be broken. Let's see if that's going to happen. I'll just draw a line right there so we can see it. So for this impulse to a push, this is a pretty big risk, and I don't think I like that. So this would be the risk range, which means that the profit range would have to be something like this. I'm not confident with that coming out of the double top. So this looks like it's probably going to form more of a wedge. Now, whether or not it actually forms a wedge and fills out, no idea. Nobody knows that. Can't predict anything. But we do know what potential there is. So that's one potential setup, is it's going to probably form into a wedge or maybe an ascending wedge. But there's no guarantee that's going to happen. This could just as easily be that 25% pullback and then H-shaped continuation. So there's no point in trying to predict stuff, you know. That is something that a lot of people do, and that's what hurts them. So you got to be careful. It's easy to try to want to, you know, get ahead of things and be confident and stuff, but that is not the way to do it if you want to be successful long term. So short term, this looks like H-shaped continuation to the downside personally, and that's the overall setup. And we've got that that double top entry or confirmation, I'm sorry, right here. So if it does turn into H-shaped continuation, the likelihood of that hitting and falling down hard is pretty high. And short term, we've got the potential here for a wedge, right? So let's just keep an eye on that, see what that does. We know it's likely to be one of those two outcomes. For bulls, this would be a candidate, for potential opportunities. So let's go ahead and chart it out. Let's draw it. So the open here is 652, which means we need to have an entry at 653. And then the stop loss here is 1 cent down. And then we adjust the profit for that. Oops, I did too many. That 1 to 2. And that is inside the resistance level. So we're okay for that opportunity potentially, but we need it to break this. And you know what? I might actually grab one. Let's just for fun, if it happens, right? We don't want to force it until we hit that 653 level, but we do have a defined risk of 4 cents. So I'm kind of breaking my plan a little bit here just for one share, just to show you guys kind of how we do it. All right, so I'm in. Now my stop loss is going to be 1 cent below that, so 648. There we go. So let's close the position, set up the bracket. So 648. And then the target would be 660. Sorry. Took me a minute to remember my words there. 660. All right. And that is a 1 to 2 risk reward on one share. And you can see that this is the setup. I'm just going to erase all these lines because right now I don't care what happens. Right. I got my trade. I'm in. I got one share, minimal risk, 4 cents, 5 cents risk, I think it is. Basing it on these two candles here, this engulf right here. So the entry was 1 cent above this guy. Stop loss is 1 cent below the lower of the two candles, which is this guy. So 648. Entry was 653. Target is 1 to 2 ratio, and it's inside of a resistance level, so I don't have to worry about something, hitting its head. So target is 660. Does that make sense? I want to make sure that all this stuff is clean and makes sense to everybody. I don't want you guys like throwing 90% of your portfolio into these. Just trade it. Just try one share at a time, practice it, see if everything makes sense. Now, if this falls down and we get that H-shaped continuation, I don't want to be in the trade, and I'll just take that realized loss because I don't want to get caught in that. That's why I have my stop loss up here and not way down here when I'm deep red and trying to figure out where it all went wrong. That's not good for your mental health. Does anyone have any questions at all? If you do, go ahead and type it in the chat for this channel just so I can see it. And your question and answer will be on the recording so it helps other people learn. Please let me know if I'm doing a horrible job explaining this. Sentinel Black says, great work. Does it make sense, though? Is it nice and clean? Is it something we can follow? Awesome. Thank you, then. That's good feedback. I just want to make sure I'm explaining things and hopefully visualizing them in a way that makes sense. Fear, sorry. Does Webull not have the PDT requirement, and wouldn't these multiple trades count toward that rule? That is a great question. I'm glad you asked because that's something we don't really visit very often anymore. It is covered in the PB University, but the PDT rule is a FINRA regulation. That's a regulatory agency. There's SEC FINRA. That only applies to margin accounts, and that was implemented back in the 90s to kind of protect traders from over trading. It only applies to margin accounts because those funds immediately settle. So you can, well, they don't immediately settle, but they're immediately available for reuse. And if you have a margin account and you just trade, your broker is going to be on the hook because it's their money that you're using while yours settles. And, a lot of people ended up hurting themselves. Okay, so it looks like our Fisker one share stopped out for, let me just refresh this so I can get that total. That's going to take a second. But yeah, if you're on a margin account, if you have more than 25K at the close of the previous day, the PDT rule doesn't apply for that following day. But I'm on a cash account. So I have to use settled funds, which means that if I like this sell right here, this the amount that I've sold today, I traded on like 25 bucks today. Now that I've sold, I have to wait 2 more days for those funds to settle before I can use them again to buy and sell. I could buy stuff with unsettled funds, but if I do and then I end up selling before they settle, I'll get a good faith violation, and then that's potential account restriction. So there's just 2 different account types, and understanding them gives you some advantages and disadvantages. Yeah, it forces you to cool down. Now, since I'm on a cash account, that's why I'm limiting myself to 33% of the amount available for speculative trades to be used per day, because that rolls them day after day after day. So I always have 1/3 of the speculative amount ready to trade with. Does that make sense? I know it's kind of a wonky concept for a lot of new traders, so I want to make sure it doesn't seem too confusing. But basically, I'm on a cash account, so if I use 1/3 of that, easy peasy. I don't have to worry about any of the other stuff. Oh, you didn't? Yeah, didn't realize it was a cash account. Yeah, that's just the way it shakes out. I do have margin accounts also. I just trade with those slightly differently. Now, overnight trades on margin accounts, those are amazing. It's a great way to get around the PDT rule because you're not trading within the same session. And one thing that I think catches new people is that if you sell something and then you buy it back the same day, that counts as a day trade. So if you buy it and then sell it the same day, or if you sell it and then buy it back the same day, those are both day trades. Now you can buy, and then sell at the end of the day if you want. That still only counts as one day trade for most brokers. Some brokers have additional restrictions on top of the FINRA stuff just to protect themselves, but it's the round trip changes of ownership in the position that counts as a day trade within the same trading day. All right, so it looks like we got the H-shaped continuation here. We got the, let me just minimize this OHLC. So right here, okay, we got the impulse. We got the retrace, the 25% was hit, and then it went into indecision mode. It didn't come up here and test this retracement bracket for the golden fib, but instead we got a new lower low. So this is H-shaped continuation. It's a impulse, shallow pullback, continuation of new lows. So that's what we got. That's why we stopped out. We took the opportunity for it to continue back up to the upside with this engulf right here. It failed. We took the stop loss, no questions asked. Took a small loss, and it continued to form a new low. And if it breaches below here, which it looks like it touched really closely, so if bulls don't push it up here, that's going to be an even bigger bloodbath that I probably wouldn't want to be part of. So that's why we just take the small, super tiny hit when it's appropriate, and then we don't have to worry about bleeding out and stress and being stressed out trying to figure out, what to do with the position to salvage it. Sentinel Black says $3 to trade $1 each day, 2 days to settle. You always have $1 available to trade. Exactly. That's the concept. We just roll a third of the funds every day as a maximum, right? You don't have to use the full amount every day. If you've got like $20 to trade each day, like I have $70 to trade with on this small account. That's just what's left. So that means if I trade with $20 a day, I'll have $10 left over just as cash sitting on the side, which is always good to have in a pinch, or if you see a really good opportunity, or if you just want to pick up a more aggressive like dividend position, which is kind of what I'm building into on this. I will be reserving some of that cash from the speculative amount just for the ex-div trades, just to kind of speed up that dividend process. So it's a process. You just got to have a system, and whatever that system is, as long as you understand the boundaries in place, and in this case, the PDT rule is a boundary for margin accounts, you'll have a good time. Taylor says, if you leg out up a spread on the same day you open it, it counts as 2 days. Yeah, you got to be careful with the spreads and stuff because you're buying 2 contracts and then, yeah, they're separate. All right, so it looks like we hit our double top entry here. The neckline was broken, so we'll see if this turns into a massacre or if it's just going to come down here and test support. But either way, we stopped out up here, so we don't have to worry about what's going on down here and listening to all these people scream and smash their keyboards. Ethan says, if you trade options only on Thinkorswim, at least it settles the next. Yeah, so that's most brokers. The option funds, when you sell options, it settles the next day on a cash account. Stock is T+2. Some are T+3, some are T+5. So you got to really look into your broker. Now, Webull, it's T+2 for equities, for shares, and then the next day for options. So if you're on a cash account, you can use your whole account if you want to, if you're crazy, for option trades, and they'll just be available the next day to trade. So for the more aggressive, more risk management oriented traders that can manage that risk and cut those positions effectively, that's awesome because you could just trade options all day, every day. If you're getting your butt handed to you and you're trying to trade SPY all day and you can't figure out how to cut those losses, you're only going to be able to do that for like 2 or 3 days and then you're done. So it's very important to know that just because you can doesn't mean you should. And as a tag man used to say, walking around with a cash account is walking around with a loaded gun. Your finger's just on the trigger all day. It's, yeah, as Duco said, it's a great way to lose extra money. We've all been there. I've blown up accounts so many times when I started just because I could. I was like, oh, I'm just going to trade options. I'll make it back. I'll just add here. I'll average down a little bit. And then it just doesn't feel good. So I want to get you guys out of the cycle of just depositing money over and over and over again and then giving it to the market. And I'd rather get you into a cycle where if you're making those consistent contributions, it's going to mean something at the end of the month because you're not giving it all away. So if you take yourself today and yourself a month from now and you clone that, so you got 4 you total, the you and the you a month from now that are making consistent contributions and using less of that money for those higher risk speculative trades is going to have a good starting point the following month. You're going to have a good chunk of that money in investments, dividends, passive income, whatever your particular flavor is. But if you take the you and the you a month from now that just blows out on options trades, or you're trying to figure it out and taking extra risks and you lose it, that following month, that version of you is just going to start over because you're just going to keep depositing money, losing it, deposit money, lose it. We don't want to see that. So if you're struggling with the speculative trades and you're getting frustrated and you feel like you can't figure it out, you got to build some sort of passive something into your portfolio at some point, right? Ultimately, this is just a savings account and you control the interest rate. That's all I'm doing on this account. I'm adding $500 a month. And if you can't add $500 a month, that's okay. Add $20 a month, add $50 a month, whatever you can afford, and you're not going to need it back immediately. You can always throw it into a portfolio and just let it sit there. Robinhood has cash back on settled funds. That's a pretty good way to just earn, I think it's like 4.9% or something like that, just for having cash in the account, because they want to use your money too, right? And if you took the bulk of your position and put it into actual growth that doesn't rely on you trying to figure out how to chart and when to enter, when to exit, and all that good stuff, it'll grow passively too. So rather than putting the bulk of your investment into risky trades like SPY and the Qs and Tesla and stuff, add those as dessert, right? Have them on the top, have them on the side. Don't make that your main course meal if you're struggling, and you'll have a much better time in the market. And that's all I'm doing with this account. I'm just, the bulk of it's going into dividend positions. It's a $500 account, you can see. Obviously I'm speculative trading a little bit, here and there, a couple shares. I'm on a $500 account. I'm not going to go balls to the wall, but $312 is in Johnson & Johnson. That's a dividend stock. I want to have that passive income. And you can see it's down 4.63%. It's a $300 position. So it's down $15.20. That's okay, because the purpose of this account isn't to have those short-term speculative trades. It's to build a position out over a long period of time, several years, and to rake in dividends on a consistent basis. So I don't have to worry about what the price does. That's just all noise. If I have to sell these shares and I have to realize this loss, all I have to do at that point is just not re-enter it for a month, and I can claim that loss on my taxes and get it back up to a certain amount per year, and then it carries forward. So I have everything planned out. I don't have to think about anything in the moment because I know exactly what to do. And for the speculative stuff, I know exactly what to do there too. I don't have to get stressed out about anything. Like for this, for example, we had a potential bounce, potential wedge here. And we saw a engulfing opportunity. We took it. It had minimal risk. That was the third trade of the day that had minimal risk. And we stopped out up here, right? We stopped right here. As soon as this red candle broke below the low of this candle, we stopped. We had very clear, specific criteria to follow. We didn't have to think. There was no emotions. There's no guessing. And right now the price is all the way down here. And there's people that are still holding it that I guarantee you bought right here along with us. But we stopped out. We took that small hit, no questions asked. So we're not down here stressed out trying to figure out, it might bounce here. We're looking for a re-entry down here. We're not looking for a minimal cut loss or to add down, because that's, here we go on SPY. That's pushing down. Good. So just to kind of reiterate here on SPY, the closing bracket, right? Let's just draw that out. Okay, so let's draw that, and then right there. So the price wants to come into this bracket. That's kind of all we're seeing today. So if we did look for bearish opportunities, we had a couple of them. Right, that's the cool part. We just have to figure out where the price wants to go, and if we don't know that, that's okay. But ultimately, we're just looking for those small risk opportunities. So in this case, we had a beautiful one right here. Okay, beautiful. And we had another one right here. And and we had one right here. If you want to combine those, I wouldn't, but you could, right? Because that still counts as a red candle. You just kick it up a time frame, and it's an engulfing candle. And that's it. That's all we had to do. Now, there was some other opportunities over here for sure, right? Like this guy. It just happens to have been a stop out. That's okay, right? Because our stops are smaller than our profits. This guy as well. It just happens to have been a stop out. Or, there was some opportunity here for profit, but ultimately it stopped out. Similar to, I turned off my OHLC. Yeah, that broke. Okay. So this one here as well. That was a bearish engulfing opportunity. So, it's not about getting the perfect entry. It's about identifying the perfect risk and then trading it appropriately on reasonable position sizes. And all the while, you've got stuff growing in the background. So for all the people here that were hoping it would bounce here, it didn't, right? So not only did they buy here, fail to take a stop here, fail to bounce here, fail to take a stop here if it didn't bounce, now they're still in a position where they're, 20 cents down, and they're trying to figure out if it's going to bounce at the next level and the next level and the next level. Could be all the way down here at 620. We don't know where it's going to bounce. We don't know where it's going to pull up. And I don't care because I don't have to. I identified an opportunity. I took a risk. It didn't work out. I accepted the risk as small. One of the potential outcomes that I anticipated happened, and I followed it. And that's it. That's all we have to do. We don't have to add all this extra crazy stuff in the mix and, hope and guess and see where things are going to turn around and try to predict bottoms and, all that good stuff. Because that's just extra stress. It's extra noise. So yeah, we don't want to see that. Because it hurts you guys. So if you're struggling, or maybe you're watching this on YouTube 2 years from now, it all still applies. Just focus on making those risks and losses smaller, and the profits will come to you. That's the key. Sentinel Black says, gotta actually do some work today. Thanks for a great educational morning. Thanks, man. I'm glad you were here. I will probably cut this off here pretty soon as well. Hopefully this made sense. It's that beautiful H-shaped continuation. There was no reason to be in that bullish trade after we lost that low. That's it. Yeah. If you were bearish, that would have been a beautiful entry opportunity as well. Look at how small that engulfing is. And then, of course, given that we had to break through this level here, plenty of potential. And this is the bloodbath. I did call it out. I said, that's a potential bloodbath, blah, blah, blah. Doesn't mean it was guaranteed to happen. It just means it was potentially going to happen. So in this case, there's a little bit of confirmation bias in the mix as well. So if you were a bear and you took this one, for example, with this big risk right here off this triple top, that could have bit you. It could have bit you pretty hard. But since it happens to have worked out, there's always that good feeling about I was right. I was validated. My efforts and attention got confirmed, right? But the cleaner setup, the safer setup was right here if you're a bear. This nice small engulfing candle right here, or this guy right here specifically was the best so far, because there's literally like no risk there. Yeah, so when you see your wins and losses, go back through your trades. Make sure that you were making reasonable decisions in the time, and you weren't just trying to guess, oh, it's going to bounce off of here. It's going to be a triple top, and then taking a bigger risk than you need to get the same type of trade. Now, you might miss out on this leg, or you might miss out and it might bounce and go up, and that's okay, right? Because that's all just confirmation bias from the market. Things just happen. Your goal is to manage your risk. It's not to try to predict price movement. So the sooner you get out of that mindset of it's going to go up, it's going to go down, I'm bullish, I'm bearish, it's going to bounce here, it's going to reverse off this level, and you get into a mindset of I'm going to take this very small risk opportunity because it has this much potential, and I'm going to use this size position because of this level of risk, or the type of trade, and it all fits within my trading plan, or it doesn't. And if it doesn't, you don't have to touch it. All right. So hopefully that's the key takeaway here. It's not, you have to be a master technical analyst and figure out where things are going to bounce and stuff like that. Those are opportunities. They're areas of value. But without those delicious little confirmations in the mix and following a trading plan that's going to protect you if it doesn't happen, you're not going to be a successful trader. And that's a hard conversation to have with yourself. So I want everybody here to give themselves permission to do this the right way. and to do it in a safe way. And if you can't figure it out, we're here for it. You got not just the staff, you've got a whole community here that has your back and wants you to succeed just the same. So I do have to cut the stream off here. It is 10:30 and we've been going a little over an hour. I don't want the people that are watching this on their lunch breaks or at dinner to miss stuff. So I'm going to end the recording. I'll hang out here for like a little bit in the Discord if you guys have any questions, but let me end this recording